Hi everyone, welcome to the third video of AA Crash Course for the December 23 ACCA exams. Now, till the last video, I had covered till audit evidence and the substantive procedures. I'll be continuing from the next topic in this video. Let me share the screen. So once we have collected the audit evidence, we are done with the substantive procedures. The next part is going to be the review and reporting. So before that, you need to remember one more thing called the audit documentation. Let me brief that before going with the review and reporting. So what is this audit documentation? It is the responsibility of the audit firm in order to record the work that has been performed as a part of the audit. Okay, so what are we going to do? Once we have performed the audit, we are going to record it in the working paper. So this working paper is where we are going to record typically the recording of what the audit tests we have performed and uh, the way in which we have performed, what are the tests performed, the purpose of performing such tests, and what are the conclusions that we have reached out of it. For example, during the substantive procedures, I told you we will be observing the live process being carried out, or we can even inspect the physical assets, and then we can recalculate, inquiry with the management, we can re-perform certain calculations, right? So all these tests we are going to perform as a process of audit. So what was the purpose of it, and what did we actually do, and what was our conclusion? Okay, so basically it's going to be the purpose of the audit test performed, and what did we actually do, and then what was the conclusion reached out of the audit performed. So these are all going to be recorded in the working paper. Fine. So this is audit documentation. Now, next thing is that you need to have some kind of a quality control procedure, systems, and policies in place. Okay. So the audit that we are going to carry out should have some kind of a quality control that is covered under ISA 220, that is quality control for an audit of financial statements. So this is going to define the policies, procedures, and systems that are to be in place in order to have a system of quality control. Basically, the objective of this is that the audit that we are going to carry out has to comply with the professional standards and the applicable legal and regulatory framework. Okay, then whatever report we are going to issue as a part of, once we have carried out the audit, we are going to issue an audit report. Whether the audit report in all the circumstances that are given by the firm or the engagement partner are appropriate. Okay, so these are the things that are going to be defined as an objective as per ISA 220. So basically, this quality control systems, policies, and procedures are the responsibility of the audit firm. Hope so far it's clear. We also have one more term that I want you to remember, that is called the engagement quality control review. This one I'll be defining at the end. I'll be explaining at the end of this video. Okay. So going to the next part, it's going to be review and reporting. First, I'll start with the review. Before you give out an audit report, once you have carried out all the audit tests performed and you have obtained the audit evidences, you need to carry out a review at the end before giving out a audit report. Okay. So this one is based on three particular criteria you need to do a review. That is, you have a subsequent events review, going concern review. You also have an overall review. First, I'm going to start with the subsequent events review. Okay. Subsequent events review, I'll show you a timeline and then I'll explain you. Before that, if you are a student who has completed FR, I want you to recollect IAS 10, events after reporting period. Even if you have not completed your FR paper before doing this AA, I want you to know this IAS 10 before going for the exam of AA, because this is one important criteria with which you can do the subsequent events review. Okay, so based on IAS 10, only you can carry out this subsequent events review. Under this events after reporting period, we have two events. That is an adjusting event and an non-adjusting event. So what are these basically? As the name suggests, events after reporting period, these both are going to occur only after the reporting period. But adjusting event is where the event had some kind of an evidence that the conditions existed before the date of reporting period. For a simple explanation, let me give you an example. There has been a major customer, okay? Major customer from whom you have to receive a huge amount. Now, this customer is going into liquidation. Now, this was, you were aware of this circumstance even before the reporting period. So, what should have been done in the financial statements? You should have written off the receivables from this major customer, but you have not done that. So you had an evidence that you should have written off. You had an evidence that the major customer is going into liquidation. You were well aware of it, but you did not do it. After the reporting period, you're finding it as an adjusting event, for which you have to make an adjustment in the financial statement. Non-adjusting event is where the events that are going to occur, the conditions did not exist before the reporting period, but the conditions arose after the reporting period. For example, there has been a fire in the factory or any kind of natural calamities, an earthquake has destroyed your factory. Okay, so the factory that you have recognized in your balance sheet now is of no use. It has been completely destroyed in the fire or an earthquake. You were not aware that an earthquake or a fire is going to occur after the reporting period, right? So it just occurred now. So this is called a non-adjusting event. So this basically will require a disclosure in your financial statements, notes to accounts, unless and until this is going to have an impact on your going concern. So going concern, I'll be coming when I'm going to teach you the review part of going concern. Okay. Now just remember these two things, adjusting event and a non-adjusting event. Okay. Hope it was clear. IAS 10 was clear. Now explaining with the subsequent events review. First of all, let me take as financial statements year end is December 31. Okay. So this is my date. Now, my financial statements, that is my client's financial statements, are approved. Who approves it? The board of directors, right? The financial statements are being approved on, say, 10th February. Okay. So this is December 31, my financial statements year end. 10th February is going to be the financial statements approved by the board of directors. Now, as an audit firm, I'm going to make the audit report, sign the audit report. On, say, 12th February. And then there is going to be an annual general meeting. You also call it as an AGM. So this is going to be conducted around 20th Feb. Okay. So now this is the subsequent events period. Here, as an audit firm, this is the period in which between which I have an active duty. I need to find out. So throughout this period, for the complete period of this 31 to 20th February, I will be looking for adjusting events and non-adjusting events. And I will have to perform procedures. For example, I have found out an adjusting event from December 31 to 12th February. I have found out some kind of an adjusting or a non-adjusting event. What I have to do, I have to look out for the specific case specific procedures that I can perform. Okay. And then I will have to collect audit evidence and then ask the management in order to make adjustments in the financial statements. Or if it requires a disclosure, I have asked the management to make such disclosures. If they agree to it or they don't agree to it, based on that, I will have to change my audit opinion or my audit report. Right. So this will be applicable for both this for the complete period of December 31 to 20th February. But the difference is the financial year end till the audit report signed will be called as an active duty for the audit firm. And once the audit report has been signed till the annual general meeting, it will be called the passive duty. So here basically we will be asking the management if some kind of an amendment is required in the financial statements just because of some adjusting event or non-adjusting event. We have to ask the management to amend the financial statements. If the financial statements are amended, then we will have to issue a new audit report, though it is going to be a passive duty. Otherwise, if the financial statements, though asked to amend, were not amended, it has to be discussed during the annual general meeting regarding its materiality and the other circumstances. Okay. So this is the overall subsequent events review. So you're going to look out for the adjusting or a non-adjusting event. Then you have the audit responsibility in order to evaluate the dates between which these events fall. And then you will be doing case specific audit procedures and collecting evidence. You have to communicate this with the management either to adjust these in the financial statements or disclose it in the financial statements. And based on the amendment or the disclosure, it is up to it is the responsibility of the audit firm either to change the audit opinion and the audit report. Okay. Next one will be the going concern review. Now, going with the going concern review, what is meant by going concern? First of all, going concern is where the management of the company is going to make an assumption that the company will be able to operate for a foreseeable future. Okay. Operate for a foreseeable future. What is the meaning of foreseeable future? It's nothing but 12 months from the end of accounting period. I'm writing it shortly and bad with my handwriting. Okay. So the company is making an assumption that is, this is not the responsibility of the auditor, first of all. The management of the firm that we are going to audit is going to make an assumption regarding its operations, whether it will be able to operate for a foreseeable future or not. Okay. That is called the going concern assumption that the management has made. Now it is our part as an auditor to evaluate the assumption. Okay. So how are we going to evaluate? So on what basis we will be able to know whether the company will be able to operate for a foreseeable future? You have to evaluate on certain criteria, like whether the company has some kind of negative cash flows or if there are any kind of operating losses. Okay. So if there are some kind of operating losses, major losses, and for the subsequent years there has been loss and no profit in the company, and there are more negative cash flows, and major customers are in a position that they cannot pay back the receivables, okay, so they are going into a liquidation, okay, these kind of circumstances are where you can think there is some kind of an operating indicator that could have an impact on the going concern of the client company. Then there are other financial indicators as well. For example, sorry, this is going to be a financial indicator. I'm very sorry. Sorry about that. This is a financial indicator. You also have some kind of other operating indicators where you are going to lose key customers for your company, or that is the client company, if they are going to lose key customers, and then if they are not able to pace up with the technology, then those can be operating indicators. The second one is operating indicators. Then other indicators can also be there if there are going to be some non-compliance with applicable legal and regulatory framework. The company might be in a position that going concern can be a problem one. Okay, so these are the factors that we are going to evaluate and see whether the company is in a position to continue as a going concern and whether the management's assumptions are right or wrong. Fine. So, as a part of review, I told there are going to be two responsibilities. That is, one is the management's responsibilities, and the next one is the auditor's responsibilities. Okay, so the management's responsibilities, as I told, is going to be the assumptions on the going concern. If the assumptions are correct, but still the management is telling you that there are some kind of uncertainties in the going concern, they are not very much clear 100% sure that there is going to be really a problem, but there are some plans in order to overcome that. So at present there are some uncertainties, okay, so that is called material uncertainty related to going concern. I'm writing as GC. Okay. So they are telling you there are some kind of uncertainties. Then this has to be disclosed in the financial statements. It just requires a disclosure. Or if the assumption is that the going concern basis itself is wrong, that is, the company will not be able to be a going concern in the foreseeable future, they have to make the financial statements on a breakup basis. Okay, so this is the management's responsibility. Now, as part of the auditor's responsibility, it is in our hands to evaluate the assumptions made by the management. As I told you, we are going to evaluate whether the company will be a going concern, it has any issues in the going concern. Okay, and if there are some kind of material uncertainties, whether they have disclosed it, or if there are some criteria that you have evaluated that going concern assumption itself is wrong, you have to communicate it with the management and ask them to prepare the financial statements in the breakup basis. So what are the procedures you will be following? For example, we can look at the cash flow forecast. I told there can be some negative cash flows or operating losses, right? So these kind of indicators can actually tell you whether there is a problem in the operations of the organization. Now you can evaluate the cash flow forecast. You can also review the post year end minutes of the meetings. to know if there has been any discussion regarding this operating losses or negative cash flow forecast, and whether relating to any uncertainties, what are the backup plans that they are going to have in order to mitigate all these risks and overcome this situation. So you can follow all these criterias and any other case specific procedures to know whether this going concern assumption is correct or wrong. Fine. Then you can also obtain a written representation. Written representation is a letter from the management that you can obtain to confirm that their assumptions relating to going concern are appropriate. Okay, and also what are the plans that they have for the future relating to the actions that are going to be taken to overcome any going concern uncertainties. Okay, so this is going to be written representation. Written representation, again, I want to point out that when I was talking about audit evidence in the previous video, I told any third party evidence is better than the evidence that you obtain directly from the client. So this is of less reliance, written representation, but still, this is for one form of confirmation that you can get from the management. Okay. So this is the going concern review. So hope you're clear with the subsequent events review and going concern review. Third one will be overall review. Overall review is simple. Whether the financial statements have been prepared appropriately, you're just going to ensure whether the financial statements prepared by the client company has followed appropriate accounting standards and applicable legal and regulatory framework, and whether the notes to the accounts and they have disclosed all the appropriate accounting policies that they have used. You also ensure that appropriate and sufficient and appropriate audit evidence has been obtained in order to conclude the audit opinion. Fine. So these are the normal things that you'll be looking at as a part of overall review. So this is all about the review part, that is the subsequent events review, going concern review, and the overall review. The final part will be reporting. So as of audit report is concerned, you need to find out what is going to be the audit opinion. There are two kinds of opinions. So the first one is an unmodified opinion, and a modified opinion. Unmodified opinion basically is that you are coming out with an opinion that you can give a reasonable assurance that the financial statements that you have audited are true and fair and are free from material misstatements. Okay, so that is the unmodified opinion. But modified opinion, okay, I'll come to this later. First of all, under unmodified opinion, you can add three paragraphs. That is, first one is emphasis of matters paragraph. This emphasis of matters paragraph is where you're going to highlight important disclosures. For example, in the financial statements, the company has included one important disclosure that you think, though it is an unmodified opinion, you think the users of the audit report have to know about this. So you're just going to highlight whatever has been correctly disclosed in the financial statements. You're not going to highlight any risk or anything wrong that has been made in the financial statements. So this is highlighting correct disclosures in the financial statements. That is emphasis of matters paragraph. Second one is material uncertainty relating to going concern that we were looking at so far. This one, if there is some kind of material uncertainty in the client company and whether the management has disclosed it in the financial statements. If they have appropriately disclosed in the financial statement, Then you will be providing an unmodified opinion and you will be adding a paragraph called this material uncertainty relating to going concern in your audit report. Fine. Then the next one will be other matters paragraph. This one is also related to a circumstance. For example, the audit of this client company has been carried out by any other predecessor auditor, or there has been no prior audits carried out in this client firm. Then you will be highlighting those points in other matters paragraph. So these three paragraphs are appropriate with respect to circumstance. Only if these circumstances exist, you will be adding these paragraphs in the unmodified opinion. Okay. Modified opinion, you have to remember based on the nature of circumstance. Okay. So there are two kinds of circumstances. One is material misstatement. As a process of audit, you have found out there are some kind of material misstatements and you have communicated it with the management, but the management has not agreed to correct those misstatements. They have not adjusted for it. So these are basically going to be uncorrected misstatements when you're going to make an audit opinion, right? So at that time, if there is an uncorrected material misstatement existing, you have to look whether it is material and pervasive. Okay. First one is material but not pervasive. What is being pervasive? Pervasiveness is that if this material misstatement is going to have a complete impact on the financial statements as a whole. But now I'm telling the first circumstances, this material misstatement is separately going to be material, but it is not going to affect the financial statements as a whole. Second instance is where it's going to be material as well as pervasive, which means this material misstatement, which is being uncorrected, which stays uncorrected till the audit opinion is being formulated, this could have an impact completely on the financial statements as well, okay, as a whole. So these are the two instances where you have to find out what kind of a modified opinion you're going to give. Second nature of circumstance is where you were not able to obtain sufficient appropriate audit evidence. So sufficient appropriate audit evidence not obtained. Okay. Here again, if you have not obtained audit evidence for one particular thing and it's going to be material but not pervasive, that is one instance. And the second one is it's going to be material and pervasive. Fine. So when it is going to be an uncorrected misstatement, it's going to be material but not pervasive. The audit opinion will be qualified except for, which means you are going to give a reasonable assurance that these financial statements are free from material misstatements and true and fair, except for the circumstances of this uncorrected misstatements. So that is the meaning. Same way, here again, it's going to be material but not pervasive. So I have not obtained a sufficient appropriate audit evidence. Again, this is going to be qualified except for circumstance. Okay, it's qualified except for opinion. Next one, the uncorrected material misstatement is going to be material as well as pervasive. This is going to affect the financial statements as a whole. In the first instance, I told other than this particular thing, all the other things are correct. Okay, it's free from material misstatement except for this factor. But here, I'm telling this is going to affect the financial statements as a whole. So I can only give an opinion that the uncorrected material misstatements is going to have a higher impact and the financial statements are not true and fair and are materially misstated. That's going to be my opinion. So that kind of an opinion will be called adverse opinion. Okay. Then sufficient appropriate evidence has not been obtained. So due to that, it's going to be material as well as pervasive. In this point of time, Actually, as a process of audit, we are going to obtain audit evidence, and based on that only we are going to give an opinion, right? What if I cannot obtain an audit evidence and it's going to affect the financial statements as a whole? I will not be able to give an audit opinion at all. So at this point of time, my opinion will be that I cannot come to a conclusion on these financial statements. Okay. So it's going to be a disclaimer of opinion. In simple terms, you're not going to provide any opinion on this financial statements because you are not clear and you have not got any evidence relating to it. Okay, so this is going to be modified opinion. Hope you're clear with unmodified opinion and the difference between modified opinion. Another one paragraph that you need to know is key audit matters paragraph. Key audit matters paragraph is a paragraph that is required for listed entities in appropriate circumstances. This is where the auditor will be highlighting any assessed significant risky areas or significant risk of material misstatements identified during the audit process. Or if certain things require significant auditor's judgment, then these are the things that will be highlighted under the key audit matters paragraph. Fine. Now, together for an simple understanding, together with this modified and unmodified opinion, I'll explain based on going concern that we were discussing so far. Okay, so under this going concern, there are two possibilities. First one I told is there is a material uncertainty, right? Second thing is going concern assumption itself is going to be wrong. First is that there is only an uncertainty, but the second thing is going concern assumption that has been made by the management itself is wrong. Now, as an auditor, what are the things that we will be requiring here? What we will be telling the management to do. Under this material uncertainty, we will ask the management to disclose it in the financial statements, right? So, if the management agrees to disclose it in the financial statements and they have disclosed regarding the material uncertainty in the financial statements. Now, what we will do? We will be providing an unmodified opinion and we will also include the material uncertainty related to going concern paragraph. Okay, because everything is correct. The management has agreed to disclose it in the financial statements. So we are just highlighting that factor in our audit report and we are going to give an unmodified opinion. Now, what if the management does not agree to disclose it in the financial statements? Now, what we will be doing? We have to give a modified opinion. This is going to be material and pervasive or material but not pervasive. Think about it. This is just going to be material and not pervasive because you just have a material uncertainty related to the going concern. It's not that going concern assumption itself is wrong. So you require a modified opinion just because the disclosure was not made by the management. So you're going to modify the opinion. So the opinion will be qualified except for. So qualified except for the circumstances of this material uncertainty, right? Second concept is the second one is that going concern assumption itself is wrong. Okay. Now, what will you ask the management to do? You will be asking the management to prepare the financial statements on a breakup basis. Breakup basis, and then it has to be disclosed in the financial statements, right? Now you find that the management is making all these adjustments. It's going to prepare the financial statements on a breakup basis and then it is going to make a disclosure in the financial statements. Now everything is fine. What will you do? you will give an unmodified opinion because everything is correct. The management has agreed to present it appropriately. So, unmodified opinion with EOMP paragraph. I told when I was giving an explanation regarding the emphasis of matters paragraph, I told you will be highlighting one particular disclosure that is going to be appropriate, that has to be highlighted, right? So whatever has been correctly disclosed. Financial statements has been prepared on a breakup basis and it has been correctly disclosed in the financial statements. So you're going to provide an unmodified opinion together with highlighting this in the emphasis of matters paragraph. What if the management is not okay with preparing it on a breakup basis and they are not going to disclose it in the financial statements? This is a point where you will be modifying the opinion. Modified opinion, now again think whether it is material but not pervasive or material and pervasive. Here, going concern assumption itself is completely wrong, which means the company will not be able to operate for a foreseeable future, right? Which means it has to be actually made on a breakup basis. The financial, so it's going to affect the complete financial statements as a whole. So it's going to be a modified opinion and an material and pervasive one. So your modified opinion will be adverse opinion. Fine. So I think I've covered both the unmodified opinion and modified opinion with this going concern example. Hope you are clear with the audit opinion now. Now formulating your audit report. The final one is the audit report. So basically, what are the things that an audit report will include? It will be including your title, and then title will be the independent auditor's report. So the first thing will be the title. Second one will be the addressee. Okay. Third one will be the opinion. That is the audit opinion that you have decided, whether it's going to be an unmodified opinion or a modified opinion. Okay. If it's a modified opinion, it can be a qualified opinion or adverse opinion or even a disclaimer of opinion. Then, basis for opinion. This will be supporting this part. What is the basis for me giving such an opinion? Okay, so that is basis for opinion. Then I told we have other paragraphs like material uncertainty relating to going concern. If it's a listed entity, then you will have to give a key audit matters paragraph. In case if there is appropriate with the circumstance, if there is a material uncertainty relating to going concern, you will be adding those paragraphs also. If there is a emphasis of matters paragraph, you will be adding it. Then if there is an other matters paragraph, okay. So these are appropriate with the circumstances, okay. Then finally, we will be coming with management's responsibilities will be listed, and then the auditor's responsibilities. And finally, you will be having the engagement partner's name, address, and the signature. You will also be having report on legal requirements. Okay, that also will be a paragraph. Report on legal requirements, legal and regulatory requirements. Yeah, one more paragraph I have left, that is other information paragraph. Okay, so other information paragraph is also relevant to the circumstance. For example, if there is some kind of an audit report or a report that you have not audited. Example, there's a director's report being issued by the client firm. You are not going to audit that. So you're just giving an information to the users of the audit report that this director report is not part of the audit, so I'm not giving my opinion on this director's report. Okay, so that kind of in that kind of circumstances you can also include a other information paragraph. Okay, so this is all about the review and reporting. So in this video, I had started from audit documentation and now we have ended with audit report. One more thing, finally, I wanted to discuss the engagement quality control review. This is also called, in simple terms, you can call it as EQCR. Okay. Engagement quality control review is where this will be carried out normally by an independent reviewer. Okay. So this one I wanted to discuss with ISA 220, but I'm discussing at the last because this independent reviewer can be, for example, another partner. Okay. They will be reviewing the audit report. Okay. So this can be either a pre-issuance review. This is normally called a hot review. This is before issuing the audit report, a review, independent review will be carried out. Okay. And there is also a post issuance review. Either of it will be carried out. Post issuance review will also be called as a cold review. This one is normally carried out after the audit report has been issued. So as the audit report has already been issued and you're going to carry out an audit, this will not have a major impact on the audit report. This can help you have some proper quality procedures for the upcoming years. Okay. So this can enhance your quality in the upcoming years. Fine. So this is basically the thing that you need to know about EQCR. Now that's the end of the syllabus recap. I'll share the link of my first video and second video. That is a part one. I have split it into three videos, video one, video two, and video three. So this will be a syllabus recap. Second part will be mock debrief that I'll be sharing soon. And third part will be cracking the MCQs. So I'll be helping you with how to crack the MCQs. So I'll be uploading all those videos shortly. Okay. Thank you.